Good afternoon, everyone. Welcome to our training for today entitled Annual Income Tax Computation and Preparation. So, our discussion for today will focus on the corporate and personal income tax um, in preparation for the annual submission of the ITR. Okay, so let's proceed. Income tax is a tax imposed on individuals or corporations on their income or profits earned from business, profession, and other services. So, which is in the conduct of trade or business and profession. Okay, so today our topic will focus on how income tax is imposed on individuals and corporations, and uh, how to determine the taxable income, or how do we get the taxable income. So income tax as imposed on individuals. So we have here citizens, non-resident citizens, resident alien, and non-resident alien. Citizens are taxed on their income from within or outside the Philippines. So worldwide yung kanilang source. So they are taxed, the citizens are taxed from their worldwide source of income. So they are taxed approximately from 0% to 35%. Non-resident citizens, resident aliens, and non-resident aliens are taxed only from the sources within the Philippines. Whatever they earn abroad is not taxed in the Philippines. Non-resident citizens are also taxed at 0% to 35%, similar to uh, the citizens or the resident citizens. In the case of overseas contract workers, since if their income is earned outside the Philippines, they are not taxable, or the income that they earned outside or the income that they earned abroad was not taxable in the Philippines, so they are exempt. So uh, this is the same with those individuals who have rendered more than 183 days, or I mean less than 183 days in the Philippines. So if an individual serve or perform services in the Philippines less than less than 183 days, the income that they earned here in the Philippines is not subject to tax, or they are exempt. Resident alien is similar as to the rate imposed, while for the non-resident aliens, it could be classified as engaged in trade or business and not engaged in trade and business. So how to determine if an individual is engaged in trade, or a non-resident alien is engaged in trade or not? So to determine if they are engaged or not is the 180 days period test. So if the resident alien um, stayed here in the Philippines, perform services within a period less than 180 days, then he is not engaged in trade or business. If it is more than 180 days, then that individual or that non-resident alien will be considered as engaged in trade or business. So the tax rate to be imposed for non-resident aliens that is engaged in trade or business is from 0 to 35%. While for those who are not engaged in trade or business, the rate imposed is equivalent to 25% final tax. So why final tax? So since they are not here in the Philippines, they have no presence here in the Philippines, or they are not registered here in the Philippines. So those who are paying or paying for their services must withhold a 25% final tax on the services or the income that they earned. Okay. So next, there are two kinds of income tax rate that was being imposed in the Philippines. Previously, before the introduction of the train law, we only have graduated income tax rate. But upon the imposition or uh, the enactment of the Republic Act 10, 10946, uh, there is an additional tax rate at the option of the individual taxpayers at a rate of 8%. So individuals earn income from different types. It could be from compensation, could be an income from profession, or income from business in case of self-employed individuals. Income from business and income from profession could be taxed at graduated income tax rate or at special tax rate of 8%, while compensation income could only be taxed based on the graduated income tax rates. So for the graduated income tax rate, this is the schedule, this is the updated schedule based on the train law. So as you can see, from those who are having an annual taxable income of 250,000 and below is at taxed at 0%. While those who are over 8 million pesos will have a tax due of 2,410,000 plus 35% of the excess over the 8 million. So that's 8 million minus 8 million minus whatever the taxable amount um multiplied by the 35% tax rate. So based on the percentage of taxpayers, based on the data that have been gathered, so 83% of the taxpayers belong to those who are exempt, while only 0.1% or 10% of the population or population of working class belongs to the 35% tax rate, the maximum. This schedule is applicable only from 2018 up to 2022. Starting 20 Starting 2023, another schedule will be released as basis of the graduated income tax rate. So again, from those who are having um, 0 to 250,000 peso annual taxable income will have a tax rate of 0% or they will still be exempt. While the base, the base still remain, but the tax rate or the tax due, the initial tax due is different now. It was lessened. So as you can see, for those who are having 400 to 800 taxable income, so the initial tax is 30,000, whereas when it comes to 2023, it will become 22,500 plus 20%, while currently it was 25%. So if the income is over 8 million, the initial tax is 2.4 million plus 35% of the excess, while in 2023, it will be reduced to 2.2 million plus 35% of the excess over 8 million. Okay. Special tax rate of 8%. So The 8% is a tax on gross sales or receipts and other income in excess of the 250,000, and this is in lieu of the graduated income tax rates and percentage tax. Please take note that compensation income is always subject to graduated income tax rates, and thus the special tax rate of 8% will not be applicable. Conditions to avail the special tax rate of 8%. So, the gross sales or receipts of an individual must not exceed the VAT threshold of 3 million pesos, and or they must not voluntarily registered as VAT taxpayer. There are some taxpayers that even though that their gross sales or receipts did not go above or did not meet the 3 million VAT threshold requirement, some of them actually voluntarily registers as VAT taxpayer. So an individual if an individual opt to become a VAT registered taxpayer, he can no longer avail of the special tax rate of 8%. Okay, another condition is that the income must not be received or must not come from a general professional partnership. This is in the case of the partners of the general professional partnership. The rationale with this is that um, the general professional partnership already uh, claimed for deductions, already has the so what was being distributed was the net income of the general partnership. So that's why they the partners of the general partnership's income was just is only to be subjected to graduated income tax rates. So how to avail the special tax rate of 8%? First, first option is upon registration. Second option is upon election of 8% income tax in the first quarter income tax return or quarterly percentage tax return. So this is for those who were uh, initially 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 registered um, under the graduated income tax rates, but was later determined uh, that the income or the gross sales or gross receipts will not be equivalent to 3 million pesos. So upon election, it is applicable only a year after the business commence for those who are initially registered under graduated income tax. And please take note that upon election of the 8% income tax, it is already irrevocable for one whole taxable year. So regardless if you elect oh if you elect 8% income tax or graduated income tax, so that is irrevocable. So it will apply to the second, third, and annual tax return filings for the year. So if upon amendment of the first income tax or second quarterly income tax return, you cannot still change the election you have chosen um, on the first quarter of the income tax return filing. So that's why it's irrevocable. Next, in the case of individuals who have mixed income, the special deduction of 250,000 is not applicable, is no longer applicable for the income, for the computation of income tax under the income of income for business and profession. So this 250,000 was already used up in the computation of the graduated income tax rates for the income under the compensation. So since a mixed income earner may earn may a mixed income earner is actually um, determined to have a compensation income and an income from business or an income from profession. So, um, in the computation of income tax due, it was the 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 compensation income was first being computed, and then the 250,000 will no longer apply to the application if in case uh, if in case the individual opted to use the special tax rate of 8% to its income from profession or income from business. Next, let's see how income tax is being imposed on corporations. So corporations, we have domestic and foreign corporations. Domestic corporations, similar to the citizens, is taxable from the sources worldwide at 30% in general, while foreign corporations were usually taxed based on the profits that they have earned only in the Philippines. So whatever they earned abroad is not taxable in the Philippines. So foreign corporations, we have two kinds of foreign corporation. One was a resident foreign corporation, and second one is a non-resident foreign corporation. So resident foreign corporation, it means that they have an existing establishment here in the Philippines. While non-resident foreign corporations, a they may not have an existing place of management, an existing permanent establishment here in the Philippines. So resident foreign corporations are taxed similarly with domestic corporations. The only difference is the source of income that is being taxed. While non-resident for foreign corporation is is the same has the same rate, but the concept is on final tax. Since, as explained earlier, they do not have permanent establishment here in the Philippines. So the ones who are paying the tax on their behalf are their customers. Domestic corporations in general, we have different kinds of domestic corporations. In general, those that are involved in the manufacturing, service, etc. So another one is proprietary educational institutions or nonprofit hospitals, non-stock nonprofit educational institutions and other nonprofit organizations, and government-owned and controlled corporations. So in general, domestic corporations are taxed at 30%, while proprietary educational institutions or nonprofit hospitals are taxed at 10%, provided that the income from their un- that the income unrelated to their main source of income is not more than 50%. So, dapat less than 50% lang ng total income nila yung other income. Next, non-stock, non-profited educational institutions and other non-profit organizations are exempt. While this is an assumption that their assets and revenue is 100% used for educational purposes only. Government-owned and controlled corporations are taxed at 30%, similar to domestic corporations in general. Exceptions are the GSIS, SSS, PhilHealth, and local water districts. Before the train, um, PAGCOR and PCSO are among the exceptions. However, uh, upon the release of train, so the PAGCOR and PCSO were no longer on the list of the exceptions of government-owned and controlled corporations. That should be uh, exempt from the imposition of tax. Resident foreign corporations. So any resident foreign corporation is including branch offices, international carriers and gross Philippine billings, offshore business units and foreign currency deposit units of depository banks, regional operating headquarters earning income from the Philippines, and regional or area headquarters of multinational corporations that do not earn or derive income from the Philippines. So resident foreign corporations in general is taxed at 30% from sources within the Philippines. So okay. Upon remittance for branch offices, upon remittance of certain income to their home office is subject to 15% branch profit remittance tax. So this branch profit remittance tax, if is applicable or imposable if there is an earmark amount for subject for remittance. So if there is none, there is no branch profit remittance tax. International carriers on gross Philippine billings is taxed at 2.5%. Offshore business units and foreign currency deposit units of the depository banks exempt from the imposition of tax. Regional operating headquarters is taxed at 10%. While those regional headquarters that do not earn or derive income from the Philippines are exempt from the imposition of income tax. Next, non-resident foreign corporations. Apart from the general non-resident foreign corporations, we have non-resident cinematographic film owner, lessor, or distributor, non-resident owner or lessor of vessels chartered by Philippine nationals, and non-resident owner or lessor of aircraft, machineries, and other equipment. So non-resident foreign corporations in general are taxed at 30%, while non-resident cinematographic film lessor or distributor at 25%, for vessels chartered by Philippine nationals 4.5%, aircraft, machineries, and other equipment 7.5%. So these taxes are all final tax. So the ones paying, although the income or the tax was being withhold on the payment, the person responsible for the remittance of these taxes is the customer or the payer. When when are non-resident foreign corporations exempt? So non-resident foreign corporations are exempt if there is no permanent establishment. So what is permanent establishment? Permanent establishment is a fixed place. So it could be a place of management, office, a branch, or workshop that is situated here in the Philippines. It could be, apart from a place, it could be dependent agents. So a dependent agent could be someone, or it could be someone or a corporation that is uh, that is where the non-resident corporation has controlled upon, or the non-resident foreign corporation has significant control over the dependent agent, or an agent. So it is considered as dependent. The service is performed in the Philippines for more than 180 days in a year. In some treaties, it could be noted that the days were actually 183 days. So if the services is not performed in the Philippines or is performed abroad, the there is no permanent establishment. Thus, whatever services performed by a non-resident foreign corporation outside the Philippines should be exempt from the imposition of tax. So whatever income they earn is not subject to income tax. Now, income tax is imposed on taxable income. So let's determine what is taxable income. Based on the tax code. So this means the the pertinent items of gross income specified in the tax code as amended, less the deductions, if any, authorized for such types of income by the tax code or special laws. So in a lighter sense, or in a more simple explanation, it is revenue minus business expenses. That is the taxable income. Gross income. So income is all wealth or income derived from whatever source. So what sources are we talking about? It could be from capital, from labor, from business, or both combined. So this is distinct from principal or capital. So the sources could be usually labor, or the use of capital for which the term is included for convenience, land, profits derived from the sale or exchange of capital assets. So these are the gross income included in the tax code, but it is not limited to those that enumerated here in this PowerPoint. So number one, compensation for services. Next, income from trade, business or profession. Gains from dealings in property. So if you have a property, if you sell it, so any gains, so we have selling price minus cost, and any gains from it is considered as gross income of the taxpayer. Interest, so it could be from a loan, or uh, whatever based on an indebtedness of a customer from from the taxpayer. rentals. So obviously, this is for those who are leasing properties. So any income earned for leasing any properties, personal properties or real properties is called rent. Royalties. This is um for the use, income generated for the use of one's property. So it could be in the form of a copyright or patent or franchise, etc. Dividends. This is um, uh, for for stockholders. This is the income they receive from corporations. Annuities. This is related to insurance contracts, the income earned from insurance contracts, prizes and winnings. Prizes and winnings is included in the specifically prizes and winnings from PCSO and PAGCOR uh, are included in the gross income. So we have prizes and winnings that are exempt from the imposition of taxes. Next, pensions or retirement plans or benefit, and partners' distributive share from the net income of a general professional partnership. Now, what are the exclusions? Number one is life insurance. So, except if there is an interest income earned, any interest income earned from the life insurance is included as part of the gross income or part of the taxable income. So, amount received by insured as a return of premium, gifts, bequests, and devices, except for the income earned for the property being donated. So if there is an income on the property being donated, then the income must form part of the gross income. Compensation for injuries or sickness. So this is from health from accident or health insurance, coming from health and accident insurance. Income exempt under treaty. There are certain provisions that under some treaties that may not be subject to income tax. Income derived by foreign government, gains from sale of bonds, debentures, or other certificate of indebtedness, income derived by government or its political subdivisions. So, since uh, governments are exempt from the imposition of tax based on our discussion last time. So any income derived by the government or its political subdivisions is not part of the taxable income. Prizes and awards. The prizes and awards must be of religious, charitable, scientific, educational, artistic, literary, or civic achievement for it to be excluded. Prizes and awards in sports competition, 13th month pay and other benefits, but not exceeding the 90,000. Any amount exceeding to the threshold of 90,000 is part of the gross taxable income. GSIS, SSS, Medicare, and other contributions, de minimis benefits. So these exclusions are gross income by nature. However, they are excluded from the computation of the gross taxable income of a taxpayer. Another is retirement benefits, pensions, gratuities, etc. So for the retirement benefits, um, we have a kind of benefit based on the labor code. Uh, so that is under RA number 7641. So it says under the Republic Act that those that have at least 10 years in service and not less than 50 years of age is subject to receive retirement benefits. However, for the exemption of these retirement benefits, it may be claimed only once. Next, as a consequence of separation. Separation pay um, usually is not taxable if it is beyond the control of the individual or the person receiving the separation pay. Received by citizens of the Philippines or aliens who come to reside permanently in the Philippines from foreign government agencies and other institutions, private or public. So I am discussing these retirement benefits that are to be exempted from the imposition of tax. Benefits due under the laws of the United States administered by the United States Veterans Administration and those received under SSS. So ito yung pension under Republic Act number 8282. Those received under GSIS under Republic Act number 8291. So these are the exempt retirement benefits. Now, we have discussed the gross income. Now we will discuss the allowable deductions. So we have two methods of deduction. First one is the regular or itemized deduction, while the second one is the optional standard deduction. Before we go to details, let us first differentiate uh, what is uh, what is being deducted from a compensation income and being deducted from the income from business or practice of profession. So under the compensation income, we are deducting SSS, PhilHealth, and Pag-ibig contributions, as well as the minimis benefits, 13th month pay, and other benefits that is not more than 90,000, retirement pay, and retirement pay. So these deductions are non-taxable income. So meaning they are just exclusions from the income. While income from business or practice of profession, we have expenses in general, interest, taxes, losses, bad debts, depreciation, depletion, charitable contributions, research and development, and pension trust. So these are deductions. So by nature, uh, under the compensation income, the exclusions from the exclusions from the income are gross income by nature. It's just so happened that they are not just taxable, while those that are enumerated below the income from business or practice of profession are deductions by nature or expenses which subject which is subject to um, provisions of tax deductibility. Okay, so let's discuss the expenses in general. So there are requirements for an expense to be deductible. Number one, it must be ordinary and necessary. So ordinary in the course of trade and necessary in the course of trade or business. So when we say ordinary, it is usual, it is normally used, normally expensed. For example, utilities. So um, one cannot um, operate without electricity, without water in case of carinderias, for example, or restaurants. Another thing is um, you cannot for electricity you cannot have your office being operational without electricity. You cannot turn on your laptop to use for use to record or to account for an income or expense of the company, or simply plan, or etc. Ordinary, necessary. So electricity is necessary. Without it, nothing is operational. Water is necessary. What else? The place of business is necessary. If you do not have a place of business, then you cannot conduct um, trade or sale. You need people. So you need people to help you, to assist you in selling your products or market your products. Okay, so those are some examples of expenses. Another requirement or requisite for deductibility of expenses is that it must be paid, accrued, or incurred during the taxable year. So if you paid rental for 2020, then it should be corded in 2020. It should be paid in 2020. So this this rent, this certain expense is deductible for tax purposes. So you cannot claim expenses that are beyond the taxable year. So for example, if you pay professional services last year for 2021, for 2020, you cannot claim the professional services as expense in 2021. It is already beyond. So as a requirement, it should be during the taxable year. It should be paid, accrued, and incurred during the taxable year. So in the conduct of trade, business, or profession. Another uh, requirement is that it must be substantiated by adequate proof. By adequate proof, it means that it should be substantiated by official receipt for services in the performance of services and sales invoices for the sale of goods or properties. So we have actually under the memorandums issued by the BIR, there is actually two kinds of um, substantiation. So the primary and the supplementary. So the ORs and the invoices belongs to the primary uh, primary primary sources or primary proof of sources. The supplementary invoices, this examples of this are the acknowledgement receipts, delivery receipts, etc. During the audit of the BIR, only the primary source documents were being um, asked by them for as an adequate proof of the expenses. Next, all expenses must be subjected to withholding tax. So there are certain expenses that that is subject to withholding tax. There are some that are not. So for those expenses that are subject to the imposition of withholding tax, an expense must um, must have a remitted withholding tax, must have a corresponding remittance of withholding tax for it to become deductible. So without the payment of withholding tax, it could render your expenses, or it could make your expenses disallowed for income tax purposes. However, payment of withholding tax alone is not enough proof that it is substantiated, or it is not an adequate proof that the expense is valid. So for the expenses to still become valid, it must be substantiated by at least an OR or invoice. Okay. Next, expenses must not be contrary to law, morals, public policy, or order. For example of these are bribes, kickbacks, or any other similar payments like facilitation fee, yung mga lagay sa BIR. So, those are um, contrary to law. So, in case of bribes, kickbacks, or facilitation fees paid, they are not considered as deductible expenses, and they are not allowed to be deducted for income tax purposes. Expenses allowable to private educational institutions. It includes capital outlays for the expansion of school facilities, if for the expansion of school facilities, and allowance for depreciation of the school facilities. So those are some of the allowable expenses to be uh, applied to private educational institutions. Rent expense. So rent expense under PAS 17 or IFRS 16 recognizes rent based on the straight line basis or the present value of future lease payments. However, for BIR purposes, the allowed deduction is based on the actual payment of rent based on contract, without straight line or present value adjustments per PAS 17 or IFRS 16. So for example, if based on audit, the rent expense um, is equivalent to 1 million. However, the actual payment of rent expense during the year is 1.2 million. That is 10,000 a month. So the actual expense that must be deducted is the 1.2 million, the actual payment of rentals. So based on contract, the actual payment of rent based on contract and not on the FS. Next, additional rent expense. Taxes paid by a tenant to or for a landlord for business property are additional rent and constitute a deductible item to the tenant. Next, entertainment, amusement, and recreation or representation expenses. So entertainment, amusement, and recreation expenses includes representation expenses and or depreciation or rental expenses to entertainment facilities. It does not refer to fixed representation allowances that are subject to withholding tax on wages. So um, entertainment, amusement, and recreation expenses are not for the benefit of the employees or um, key personnels inside the organization. But this representation expenses are for the enjoyment of the third party. For example, um, prospect buyers, prospect customers, what else? Anyone who is not a party or anyone who is not directly related to the company should not be the subject of the entertainment, amusement, and recreation expenses. Exclusions. So if the representation expense is subject of compensation or fringe benefits, or in a simple sense, it is given to employees, then it is not representation expense. If it is for charitable or fundraising events, if it is for business meeting of stockholders, partners, or directors, business league or professional organizations meeting, if it's for promotion, marketing, and advertising, and other similar expenses of a uh, similar nature are not entertainment, amusement, and recreation expenses, and thus not be classified as such. Limitations. We have three kinds of expenses that is subject to limitations. This is the first one. So the limitations as per the tax code. Number one is for taxpayers engaged in the sale of goods, properties, um, it is 0.5% of the net sales. So net sales meaning gross sales less sales returns and allowances and discounts. So if, for example, excuse me, if, for example, let's say the company has 100,000 representation expense. The taxpayer is engaged in the sale of goods or properties. So the gross sales is equivalent to 1 million. So um, the net sales, let's say it's net already net. The net sales is equivalent to 1 million. So 1 million times 0.5% is equivalent to 5,000. This 5,000 should not be deducted for tax purposes. So if the taxpayer have 100,000 representation expenses, then this 5,000 should be deducted from the 100,000. Thus, the representation expense must be equivalent only to 95,000. This 95,000 is the allowed deduction for tax purposes. sorry, sorry. Again, nagkamali ako ng explanation. So, yung ulitin natin, So, the 5,000, so, the limit, the under the representation expenses, the 5,000 should be the limit pala of the representation expense. Meaning, the taxpayer could not go over 5,000. So, if there are 100,000 worth of representation expenses, only the 5,000 will be allowed. The 95,000 will be considered as a permanent difference. So it could no longer be deducted for tax purposes. So baliktad ako. Sorry for the confusion. So next, for those taxpayers engaged in the sale of services, including the exercise of profession and use of these or properties, the limit or the threshold is 1% of net revenues. So, balik ulit tayo sa example. If there is a 1 million revenue, net revenue, 1% of it is the limit. So that is equivalent to 10,000. So if the taxpayer has again 100,000 representation expenses, then the amount that is required to be deducted only for income tax purposes is the limit of 10,000. So the uh, the taxpayer has no benefit now over the 90,000 non-deductible expense. In case of mixed source of income, if the taxpayer is engaged in the sale of goods and services, then proportionate. So um, the amount of um, net sales times 0.5 times 1%, the amount of net sales of goods times 0.5%, and the amount of net revenues times 1%. So the resulting limits of those two shall be the amount of limit for tax purposes. In our previous example, we have 5,000 for the sale of, assuming that 1 million for net sale of, and 1 million for net revenues for the sale of services. So for the sale of goods, we have at least 5,000 of representation expenses that is deductible for tax purposes. While for sale of services, we have 10,000. So 5,000 plus 10,000 is equal to 15,000. So that is the only amount that we can credit or we can include as tax deduction for uh, income tax. So if there is a total of 100,000 representation expenses minus 15,000, the 85,000 would be disallowed for income tax purposes. Only the 15,000 would be allowed as deductible expense for tax purposes. Reportatorial requirements. So, representation expenses, for representation expenses, It is required to use the account title entertainment, amusement, and recreation expense or representation expense in the FS or ITR. And it is required to be disclosed in the notes to the FS separate as a separate line item. This is one of the priority audits of the BIR. So EAR expense should be reported in the ITR as well as a separate expense item. Next, interest. Interest may be treated as an allowable deduction or as a capital expenditure. For interest to be allowed for deduction, it must be paid or accrued or incurred within a taxable year. So interest um, should be um, incurred, for example, in 2020 for it to become deductible in 2020. Indebtedness is related to the conduct of trade, business, or profession. If the indebtedness is personal, it's related to personal business or um, personal use, then it is not deductible for tax purposes. For example, you loan uh you you entered into a loan with a bank for a car, to buy a car. So for this car is for personal use only and not for the use of the business. So any interest that you are required to pay for that specific loan is non-deductible for tax purposes under your business, under the conduct of trade or business kasi it's personal. So kumbaga, walang benefit yung business mo. So why are you claiming an expense that is related to your business? It must be in writing. An interest to be imposable must always be stipulated in writing. So if in a contract or in a loan agreement uh there is no interest stipulated or written, then there is no interest expense to be recorded for tax purposes. Indebtedness is not between related taxpayers. So uh a loan or a payable is between related taxpayers or is loaned to a to a related company or sister company, the the interest is not the interest expense is not deductible for tax purposes. So what are the examples of related taxpayers? So if there is a control between one corporation and another corporation, then if there is significant influence, another is the members of the family. What else? Key personnel management. So those are some of related parties or related taxpayers. For it to be deductible also, it should not be treated as capital expenditure. So we have there are some companies that um, records or or capitalizes interest. So once it is capitalized, the only method that it could be deductible is through depreciating the property. So iba na yung maging classification niya, hindi na siya interest. Hindi na siya as interest. And not incurred to finance petroleum exploration. Limitation. So sabi ko kanina, we have 3 kinds of expenses that have limitations. So the first one is the entertainment, amusement, and recreation expenses. The second one is interest. So the deductible interest under the tax code must be reduced by 33% of the interest income earned subject to final tax. Ito yung nagkabaliktad ako ng explanation kanina. So for example, if the taxpayer has 100,000 interest income earned, gross na to, that is subject to final tax, you must get the 33%. So the 33% of 100,000 is 33,000. So that 33,000 must be deducted to the amount of interest expense recorded in the books. So let's say, for example, we have 200,000 interest expense. So the amount that should be deductible for tax purposes is equivalent only to 167,000. So that is 200,000 of interest expense recorded in books minus the 33% um, 33% of interest based on the interest income earned. So 33,000. 200 minus 33 is equal to 167. So what is the rationale? Why do we have this kind of limitation? So this is to neutralize the impact of tax arbitrage scheme. So this is where the taxpayer is having a tax benefit on deduction of interest and lower income tax rate. So, kumbaga, ang ginagawa dito is parang, this is an example of tax avoidance scheme na ginagawa ng taxpayers. So, in order to mitigate this tax avoidance scheme of the taxpayers, so the government um, think of a way to minimize this. So, ito yon yung limitation natin sa interest. Yan. Companies tend to apply for loans to get interest expense benefit. Yan. Kasi nga naman, if i-compare yung final, kung yung tax related dun sa interest expense, interest expense on loans, diba? Ay, interest income, 20% lang siya na final tax. While for interest expense, 30% yung savings nila sa tax. So, yun yung ano. So, there is a 10% savings on tax, kumbaga. So, to minimize this tax avoidance scheme, so this is what the government pushed for as limitation. Exception of this limitation. So, if there are deficiency interests, so we have, for example, audits, VR audits, and it was found out that the taxpayer is not paying the right amount of tax, or there is under declaration of tax. So these taxes, aside from the incurrence of penalties, is subject for a deficiency interest from the time when the um, from the time of filing of the tax return up to the time of discovery of the um, at the time of discovery of the under declaration. So this deficiency interest on unpaid business and related taxes is deductible in full. However, delinquency interest is not deductible. Delinquency interest is um, arises from the time when the BIR demands um, for the payment of taxes. So upon the issuance of um, final assessment notice, or final ano yun? Final discrepancy on disputed assessment, that is the time when the delinquency interest will start. Yeah. So there is no simultaneous imposition of interest, but considering the timing, yun sila. So before the FDDA, that is the deficiency interest. From the FDDA onwards, delinquency interest yung mag-a-apply. Okay. So that's it. So deficiency interest is deductible in full, while delinquency interest is not deductible. Kasi in a sense, deficiency interest is still in a form of an indebtedness, while the delinquency interest is somehow a penalty na by nature for being delinquent. Okay, next, taxes. So what are the requirements for taxes to be deductible? It must be paid or incurred within the taxable year. So it must be connected to trade, business, or profession. For non-resident aliens engaged in trade or business and resident foreign corporations, it must be connected with income from the sources within the Philippines only. So what are the example of taxes that may be um, allowed as deduction? Percentage tax could be allowed as deduction, as this tax are imposed on the taxpayer itself. These are business taxes on the taxpayer itself, not unlike VAT that is kumbaga passed on. VAT is passed on tax. So there is a payable. The tax is being imposed on the buyer of goods and services. So the taxpayer is merely a um, parang taga-report lang. Unlike sa percentage tax, the taxpayer is the one that is being taxed. The taxpayer is being taxed on his or her gross receipts or revenue. What are the exceptions of these taxes? So income tax. Obviously, income tax is not a deductible expense. Kasi nga, di ba, doon nga tayo kukuha ng basis for income tax computation. Next, foreign income tax. If taxpayer avails of foreign tax credit. So, if a Filipino citizen, in the case of Manny Pacquiao, yan, In the case of Manny Pacquiao, um, he received an income abroad. So since since he received an income abroad, um, there there is an equivalent foreign income tax or foreign tax credit. So foreign income tax. So if this foreign income tax is not being claimed as foreign tax credit, then um, it could be subject for deductibility. However, if the taxpayer avails of, if Manny Pacquiao avails of foreign tax credits, then it could no longer be deducted as tax as tax deduction or as an expense, as a tax expense. Next, estate and donors tax. So these are not um, included as tax expense of the taxpayer. And tax assessed against local benefits of a kind that tends to increase the value of property assessed. These are special assessments related to real properties. Next, alternative treatment for taxes paid in foreign currencies. So, taxes paid in foreign currencies may be claimed as a foreign tax credit. So, the BRR requires as proof. So, the taxpayer must be able to prove the amount of income, or there must be a tax credit certificate that shows the amount of income derived from foreign sources, the amount of tax paid and incurred, and all other information necessary for the verification and computation of the tax credit. So, at the minimum, the taxpayer's name, that the nature of the income, etc. So, who are entitled and not entitled to foreign tax credits? First, first, those who are entitled to foreign tax credits are the resident citizens, domestic corporations, members of general professional partnerships, and beneficiaries of estates and trusts who are not entitled to foreign tax credits. Of course, the non-resident citizens, aliens, residents or non-residents, foreign corporations, residents or non-residents. Um, they are not entitled to foreign tax credits because their income here in their income is only taxed from within the sources of the Philippines. So there is no reason to avail of the foreign tax credit. Next, losses. So there are different kinds of losses. Number one, casualty losses. Next, net operating loss carryover. Capital losses, losses from March sales of stocks and securities, wagering losses, and abandonment losses. Casualty losses and net operating loss carryover is related to the ordinary um, uh, ordinary expenses of the taxpayer. While capital losses from the word itself is capital related, and losses from March sales, wagering losses, and abandonment losses are special losses as mentioned under the tax code. The focus of my discussion will be on the casualty losses and net operating loss carryover. So, requisites for deductibility. So, the losses must be actually sustained during the taxable year. It must not be compensated for by insurance or other forms of indemnity. In case there is an insurance or a taxpayer receive a reimbursement from the insurance company for the losses, then it must be uh, the amount of losses that must be reported must is net of the reimbursement from the insurance company. Next, it must be incurred in and connected to trade, profession, or business of the taxpayer. Another thing is that the loss must not be claimed as deduction for estate tax purposes, and it must be sustained in a closed and completed transaction. So, when we say closed and completed transaction, it means that it must be the amount of the loss or the casualty loss must be determinable. It is not just a mere estimate. Or in case of a lawsuit, there is a um, decision already from the courts. Or in case of the insurance, so the amount of um, the amount of um, the loss can be determined by the insurance company or the amount of reimbursement from the insurance company. So those are the conditions for a closed and completed transaction. So additional requirements for losses to be deductible, the properties must be used in business and are reported to BIR. So upon the happening of the loss, so it must be filed or it must be filed with the BIR. So the taxpayer must prepare all the documentary requirements necessary to be submitted to the BIR for the recognition of losses. Yeah. Damaged properties must be part of assets in the financial records of the taxpayer. Next, deduction of assets as capital assets must be properly recorded. Yan. So those are the additional requirements that must be put into consideration by the taxpayer. Next, casualty losses based on our RMO number 31/2009. So for casualty losses, when we say casualty losses, it could be um, from destruction of properties due to uh, storm, typhoon, flood, etc. Robbery, theft. So those are some of the examples of casualty losses. So for casualty losses, how to report it? The taxpayers, the taxpayer who happens to have casualty losses must submit a sworn declaration of loss and must file with the BIR within 45 days from the date of occurrence or discovery of the casualty loss. The sworn statement shall contain the nature or event that gave rise to the loss at the time of its occurrence, the description and location of the damaged properties, and the items needed to compute the losses, such as how much is the cost of the property, how much is the depreciation expense, if there is any, in case of buildings, warehouses, etc., or cars, the value of the properties before and after the event. So, in case of real properties, then um, the nearest value based on the latest appraisal, or in case of cars, for example, or vehicles used in trade or business, the cost would be determined or the value will be determined based on the original purchase price of the vehicle being damaged or destroyed and the cost of repair. the amount of insurance or other compensation received or receivable, if any. So most of the properties were actually um, under insurance. So buildings, um, cars, or vehicles are under insurance. So any amount received from the insurance company shall be deducted to the total casualty loss. If the amount of casualty loss, let's say for example, is 1 million, and then you were being reimbursed by the insurance company of an amount equivalent to 500,000, then the 500,000 is the amount of casualty loss that must be deducted for tax purposes. Next, proof of loss. So, another requirement for casualty losses, the taxpayer must obtain or provide photographs of property taken before and after the monsoon rains, showing the extent of the damage sustained. So, in case there is a um, warning of typhoons, so it seems that the taxpayer must take a photograph of the place, of the property at that time. So, kapag lumala na, so halimbawa kung binhayan or anything, pipicturean niya ulit yon. So, that's one of the evidences needed by the BIR as proof of loss. So, that is uh, an evidence before the property was damaged and after the property was damaged. So, next, documentary evidence for determining the cost of valuation of damaged properties. So, if the in case of real properties, so the taxpayer must show documentary evidence showing the cost of valuation or the proof of valuation of the damaged properties. Then, insurance policy for insured properties. If wala namang insurance, there's no need to provide. But in most cases, lagi namang may insurance ang properties. Especially kung if you are engaged in the sale of merchandise. So, some merchandise were um, for the insurance, diba? For in case of any casualty losses, there is an insurance that is kumbaga nakakabit dun sa inventories natin. Then, in case of theft or robbery during the typhoon or in case of looting after the typhoon, police report is necessary. Failure to submit the said declaration within the prescribed period may result in the disallowance of loss. So, hindi pwedeng basta lang tayo maglalagay ng loss. So, kapag naisipan natin, ay, loss na natin yan. Pwede na natin gawin yan. No. It must follow strictly the documentary requirements as suggested by the Revenue Memorandum Order number 31-2009. Inventory, in case of inventory assets disposal. So under RMO number 6-2012, the BIR will conduct the physical or ocular inspection and supervision of the destruction or disposal of inventories. So, no destruction or disposal of any inventory, machinery, or equipment shall be made without the presence and supervision of the authorized BIR representative. The BIR will issue certificate of deductibility in relation to the inventory assets disposal. So, if in case the taxpayer just deducted losses, inventory assets disposal, without coordinating this with the BIR, the said uh, deduction for losses or for the inventory assets disposal will be disallowed for income tax purposes. Next, net operating loss carryover. So the net operating loss carryover, or the NOLCO, is the excess of the allowable deduction over gross income of the business in the taxable year. So this means that the allowable deductions, or the deductions in a year, exceeds the gross income of the business. So let's say, for example, uh, the taxpayer has 2 million deductions during the year, while the gross income only amounted to 1.8 million. So there is a net operating loss amounting to 200,000. This net operating loss could be carried over up to 3 years, the next 3 consecutive years, provided that it is not previously offset as a deduction. It is not allowed as deduction if taxpayer was previ- no, it is not previously offset as deduction. Then, if the taxpayer was previously exempt from the imposition of tax, any NOLCO that um, the taxpayer incurred during his exemption cannot be carried over for the next 3 consecutive years. So, let's say, for example, company A is tax exempt until um, December 2020. So, however, the company A has an existing net operating loss of 1 million. So, this net operating loss, in case at the end of 2021, company A has a resulting taxable income of 1 million, the amount of net operating loss during 2020 cannot be carried over as a net operating loss for 2021. So the taxable income for 2021 will still remain as 1 million. So there is no benefit of um, NOLCO in that sense. Another condition for a NOLCO to be carried over is that there must be no substantial change in ownership. Okay. Next. Net operating loss carryover, or NOLCO, can be allowed as deduction in the quarterly and annual income tax return computations. So, NOLCO cannot be enjoyed if the taxpayer is subject to minimum corporate income tax. So, the discussion of minimum corporate income tax will be on Friday. So, if the taxpayer is required to pay the minimum corporate income tax, then uh, uh, there is no benefit. He no longer have, or the taxpayer no longer have the benefit to avail of the net operating loss. The application of the net operating loss cannot be interrupted even if subject to MCIT. Say, for example, there is a net operating loss incurred during 2020. However, in the same year or in the same taxable period, that the company is subject to the minimum corporate income tax instead of the regular corporate income tax. So uh, since it is said that it cannot be interrupted, so uh, in 2021, the company or the taxpayer is still subject to minimum corporate income tax. So 2020 MCIT, 2021 MCIT. The NOLCO in 2020 will still expire from 2020, 20 starting 2021, 2023. So the the NOLCO will expire on 2023. So it does not in a sense interrupts the MCIT does not interrupt um the running of the three consecutive periods as set under the tax law. Reportatorial requirements. So it must be shown as a separate item in the itemized deduction section and the reconciliation schedule of the ITR. The notes to the audited financial statements shall be presented in detail the taxable year, the losses obtained or incurred, and the amount claimed as NOLCO deduction. Yan. So failure to comply to the reportorial requirements will disqualify the taxpayer from claiming the NOLCO. Next. Under the Bayanihan to Recover as One Act, RA number 11494, the net operating loss incurred by a business for the taxable years 2020 and 2021 can be carried over as a deduction from gross income for the next 5 consecutive taxable years following the year of such loss. So from 2021 through 2026. So that is the benefit given to uh, companies or taxpayers due to the effect of the COVID-19. Bad debts. So bad debts are debts resulting from the worthlessness or uncollectibility of the amounts due to taxpayer, arising from money lent or from uncollectible amounts from sale of goods or services. So we have an accounts receivable, and from that accounts receivable, we determine that there are debts that were no longer unco- uh, that were no longer collectible or were already worthless. So what are the requirements for the deductibility of bad debts? So under RR number 5-99 as amended by RR number 25-2002, bad debts must be valid and legally demandable indebtedness. So number one, there must be an indebtedness for us to determine if there are bad debts. So uh, so that indebtedness must be validly and legally demandable. It must not be sustained in a transaction between related parties. It must be connected to trade, profession, or business. It must be actually ascertained to be worthless or uncollectible. So it must be written off. Allowance for bad debts are not considered as deductions to income tax or the taxable income since uh, allowance for bad debts are just mere estimates. So for bad debts to be written off, the amounts must be actually ascertained or the amounts must be actually determined or exact. So there are steps to be undertaken by the taxpayer to prove that he exerted diligent efforts to collect the debts. So number one, there must be sending of statement of accounts. So normally, if normally we always have in case of if you have credit cards, so normally your credit card company issues you a statement of account. So they are trying to collect from you by issuing a statement of account. If in case they were still not able to collect, they will send collection letters, or sometimes they will ask a third party to collect on their behalf. Next, giving the account to a lawyer for collection. If in case after so many efforts, after so many collection letters sent, and they receive no response from the debtor, they give this account to a lawyer for collection. Then this lawyer will contact uh, the one or the debtor, the one who's in debt, and then will try to collect for the debt. If in case uh, the lawyer failed to collect, they will file a collection case in court. So this documentation is necessary for the bad debts to be uh, to prove that there is an effort on the part of the taxpayer to collect the debts. So it could be used as a documentary requirements for uh, or documentary proof that there is a need for writing off of bad debts.
Maganda naman yan eh.
Ito, pagkali, kung ginagamit ko eh.
Ha? Maganda ko, mas maganda pa sa cellphone ko. Samsung.
Ma'am Joy.
Ay, sorry.
Ma'am Joy, pamute.
Ay, sorry. Hindi ako mukha.
Nagulat ako.
Ayan. Okay. Nashock ako dun. Okay. Next. Amendments under 25-2002. So in the case of banks, so a bank must submit a BSP monetary board written approval for the writing off of the indebtedness. So banks cannot just write off. So they need a written approval from BSP or the monetary board, whichever whichever the case may be, to write off a certain indebtedness of a debtor, of the bank debtor. Then, in case of receivables from insurance, surety companies, they cannot um, they cannot claim for bad debts, or they cannot write off debts unless they are declared due to insolvency, closed due to insolvency. So, any receivables from insurance or surety companies. So, if a taxpayer has a receivable from any insurance company, they cannot just write off the account unless that insurance company is closed and declared as insolvent. Tax benefit rule on recovery of bad debts. So, a debt which was previously found to be worthless and written off in a prior year, but subsequently collected, does not render the deduction unallowable or illegal. So, recovery does not follow the previously written off bad debts to be not allowed. So, instead, the recovery of bad debts previously allowed as deduction shall form part of the gross income since the taxpayer already received the benefit from prior deducting the bad debts in its reporting of the taxable income. Upon recovery of these bad debts, parang babawiin naman ngayon ni BIR or babawiin ngayon ng gobyerno kasi naka-benefit ka. So that's why you have to tax it again. Next, depreciation. Depreciation is the gradual diminution in useful value of a property. So this includes amortization of the value of intangible assets. It is premised on its acquisition cost. So depreciation is usually based on the acquisition cost and not the appraised value. So if, for example, uh, a machinery a machinery is a machinery is purchased at 500,000. However, it was due to business reorganization, the value of the property increased. So from 500,000 to 600,000. The basis of depreciation is not on the 600,000, but on the original cost of um, the machinery, which is the 500,000. So that's why it is premised on acquisition cost. The tax law is based on cost and not on the um, appraised value. So requirements for deductibility, it must be reasonable, and the property must be used or employed in the business or temporarily not in use. So employed in the business, it could be vehicles, buildings, computer equipments that is used in the business. Temporarily not in use if there are properties that were to uh, used to be uh, in use of the business. Like for example, a warehouse that was used to store the goods, etc., but was later abandoned or or was not in use for a number of years. So that is part of the property that is subject for depreciation, and it must be charged off during the year. Next, methods of computing depreciation. So we have the straight line method, declining balance method, sum of the years digit method, and any other method which may be prescribed by the Secretary of Finance upon recommendation of the BIR. So the method of depreciation must be explicitly mentioned or disclosed in the notes to the financial statements for um, for us to prevent or minimize the confusion on the method of depreciation being used, and that so as to avoid tax exposures. In 2012, there is a depreciation rule issued for related to the depreciation of vehicles. So first, let's discuss the deductibility. So deductibility of depreciation on vehicles related to and related expenses. So it must be substantiated with sufficient evidence. Uh, Sufficient evidence in a at a minimum must contain the amount, the details of the vehicle, yeah, and the value of the vehicle. Yeah. So for each employee, there should only there should only be one vehicle, and that vehicle must not exceed 2.4 million pesos. If it exceeds to 2.4 million pesos, no depreciation shall be allowed. The yachts, helicopters, airplanes, and or aircrafts were also uh, cannot be depreciated. So these are called non-depreciable um, vehicles. In case of those non-depreciable vehicles, the expenses on losses related to them are also disallowed. So the amount of depreciation plus the expense and losses related to the non-depreciable vehicles were disallowed for income tax purposes. Depreciation of intangible properties. So intangibles, the use of which in business is definitely limited in duration, may be the subject of depreciation allowance. So patents, copyrights, franchises. If the duration of the intangible property cannot be determined, then it could not be subject for depreciation. Charitable contributions. So this is the third um, kind of expense that have uh, a limitation. So we have entertainment, amusement, and recreation expense. Second, interest expense. And third is the charitable contributions. Okay, for charitable contributions, to be fully deductible, it must be donated to the government and any of its instrumentalities, provided that this is based on the NEDAS plan, donated to foreign institutions or international organizations, donations and prizes to athletes, and donations to NGOs accredited by PCNC. So donations made to NGOs duly accredited by PCNC must be substantiated with certificate of donation from the Dhoni institution, indicating the receipt and date of the donation and the amount thereof. So here are some of the uh, entities that are of which the donations could be deducted in full. So the Integrated Bar of the Philippines, um, DAP, Aquaculture Department of Sea, Fisheries, and Development Center, University of the Philippines, and other state colleges and universities, CCP, NC, NC, NCCA, International Rice Research Institute, Department of Science and Technology, International Red Cross and Red Crescent Movement, or Philippine National Red Cross. Limited deductibility. So the limited deductibility or the limitation is applicable to donations made to other than those subjected with full deductibility. So, for example, a mere donation to a private entity, or a mere donation to a person, or a mere donation to a non-profit organization that is not registered or accredited by Philippine Council for NGO certification. Next, these entities or donations to these entities must be subject to the payment of donors tax. Entities Donations to entities that has full deductibility is no longer subject to donors tax. So for those institutions that have limited deductibility of charitable contributions, they are subject to the payment of donors tax. So failure to pay the corresponding donors tax shall make the deduction of the charitable contribution be disallowed. So, for individual donors, um, the charitable contributions must not be in excess of 10% of the donor's income derived from trade, business, or profession. So, this is the same application with um, expense of representation expenses. So whatever is the limit here of charitable contributions, say for example, if we computed 100,000 limit for the charitable contributions and the taxpayer has 150,000 of um, the value of the donation is amounting to 150,000. Only the 100,000 could be allowed as deduction. The 50,000 the on the 50,000 the taxpayer loses his benefit. So for corporate donors, it should not be in excess of 5% of the donor's income derived from trade, business, or profession computed before the donation. So the basis, the income, the basis of income here is the net income before charitable contributions. So if we have a net income of 1 million, the charitable contributions is 150,000, then the basis of the the basis of the 10% or 5% would be the 850,000. So if it is an individual donor, it is subject to ah the basis is 10%. If it is corporate, the basis is 5%. So requisites for deductibility. So there must be an evidence or proof submitted to the BIR by showing the certificate of donation, BIR form 2322, and where indicating therein the actual receipt by the accredited non-stock non-profit organization of the donation or contribution and the date of receipt. It is a description of the properties donated and must be signed by an authorized representative, and the amount of charitable donation or contribution, if in cash, if property, whether real or personal, the acquisition cost and net book values as reflected in the financial statements of the donor. Due to the COVID-19 so of the Bayanihan to Heal as One Act, under the implementing rules and regulations of RR number 9/2020, so donations to national government and any of its agencies, there must be a notice of the donation or deed of donation as proof of charitable contributions, and that for non-stock, non-profit, or NGOs, certificate of donation through BIR form number 2322. So additional documentary requirements for the Dhoni recipient. So the accredited NGO as the donor or recipient is required to submit a liquidation report in BIR's prescribed format. In the case of local private corporations or international organizations that were uh, not accredited but works together with an accredited NGO, they are required to submit a liquidation report in BIR's prescribed format and certificate of donation or deed of donation. For the donor, so um, the donor for if the donee or the recipient is an NGO, so the donor must secure a donor's sworn certification within the prescribed format of the BIR and the BIR registered acknowledgement receipt. So in case if the donee or recipient is a local private corporation or international organization, the donor must obtain a proof of purchase if in kind, BIR registered acknowledgement receipt, and certificate of donation or deed of donation. Tax incentives for donations to public schools. So this is under the Biennial to Recover as One Act, RA number 11494. So tax exemption of personal computers, laptops, tablets, or similar equipment appropriate for use in schools that are donated for distribution to public schools during the implementation of Biennial 2 from September 15 until December 19. Next, research and development. So all costs incident to the development of an experiment or pilot model, a plant, process, product, formula, invention, and the improvement of already existing property of the type mentioned. Requirements for deductibility, it must be connected to trade, business of profession, or profession of the taxpayer, and must not be charged to capital account. Expenses that are not R&D are as follows. So if it is for the acquisition or improvement of land or for the improvement of property to be used in connection with R&D, that's not a research and development expense. If paid or incurred for the purpose of ascertaining the existence, location, extent, or quantity of any deposit of ore or other mineral, including oil or gas, is not considered as an R&D expense. R&D as deferred expense. Uh, this is capitalized R&D. So obviously, it is not treated as expense and it is chargeable to capital account, not subject to depreciation and amortized over a period of not less than 60 months. Retirement benefits. So benefits received, um, there are two kinds of benefits. So benefits received under Republic Act number 7641 and benefits received in accordance with a reasonable private benefit plan maintained by the employers. So under RA number 7641, this is what is written in the labor code. So in the absence of a reasonable private benefit plan, the RA number 7641 will be used. So under this Republic Act, the amount deductible is equivalent to the amount actually paid upon retirement. So for tax purposes, whatever is the amount actually paid, if there is a no reasonable private benefit plan, if the company do not have that private plan for its employees, then the amount that should be credited only or should be allowed as deduction only is the amount actually paid upon retirement. So accruals of pensions or retirement benefits based on RA number 7641 is not deductible. So the actual amount paid only. The retirement pay is equivalent to 1 month half salary for every year of service. The 1.5 month salary shall mean 15 days plus 1/12 of the 13th month pay and the cash equivalent of not more than 5 days of service incentive leaves. Reasonable private benefit plan. If the company has a reasonable private benefit plan, the company or the taxpayer can deduct the following. Number one, the current year contributions, and second, the prior year contributions. Current year contributions are the normal service cost based on the actuarial valuation for funding purposes are 100% deductible, while prior year contributions or past service costs which is the difference between the total current year contributions less normal service costs, is amortized over a period of 10 years. The reasonable private benefit plan must be duly registered with the BAR. Requisites for the deductibility of pensions or retirement benefit. There must be a pension or retirement plan. In the absence of a retirement plan, RA 7641 will be in place. So that is just actually based on what was actually paid upon the retirement. Next, pension plan is reasonable and actuarially sound, funded by the employer. The amount contributed must no longer be subject to the employer's control or disposition, and payment has not therefore been followed before as a deduction. So we have discussed the itemized deductions. Now let's proceed with the optional standard deduction as the second method of deduction for um, income tax purposes. So optional standard deduction is a standard deduction equivalent to 40% of gross income of the taxpayer. So this is in lieu of the itemized deductions. Gross income means the net sales minus the cost of goods and services plus other income. Optional, the method of deduction can be elected through signifying by checking the appropriate box on the ITR file. So the default is usually itemized deductions. So failure to elect the optional standard deduction would automatically um, make the deductions itemized. So again, election is irrevocable, similar to the election of uh, special tax rate of 8%. The election is irrevocable. Even if you amend the first quarter of the taxable year, you can no longer change the method of deduction being used. So if you elect optional standard deduction in the first quarter, then you can no longer change it to itemize even if you amended it. Special issues and considerations. So deductibility of accrued expenses. So as discussed earlier, expenses that could be deducted must be paid or accrued or incurred during a taxable year. However, there are some cases that accrued expenses that is based on the estimate amounts only are not subject for deductibility. However, it shall be allowed as deduction when there is a corresponding withholding tax that has been remitted or paid to the BIR. Withholding tax on accrued bonuses. So similar application with uh, the accrued expenses. So deductibility is whenever paid, accrued, or recorded as expense, provided it, that these accrued bonuses must be subjected to withholding tax on compensation. Next, deposits and advances received from customers. So cash deposits or advances shall be booked as income. Whenever the company has received cash for deposit of something or advances, like advances to supplier, this already shall be uh, advances from suppliers or advances from customers, I mean. So this shall be booked as income already and must be subject to VAT, and withholding taxes. Tax treatment of unrealized forex gains and losses. So generally, forex gains and losses are taxable or deductible only upon the occurrence of a closed and completed transaction. So in practice, forex gains and losses are reported as unrealized in the current year and realized in the succeeding year. So, bakit nagkakaroon ng ganitong practice? Kasi ang mahirap i-monitor yung forex gains and losses. So, as a result, they will recognize the unrealized gain. They will recognize the forex gains and losses as unrealized in the current year and will be assumed realized in the succeeding year. So this practice may be justified provided that its application is consistent and is not tax-driven. Okay, so that's it for the annual income tax computation and preparation part 1. So I hope you all learned something and na-refresh kayo from this discussion or topic that we have discussed. So thank you.